Let's use the insurance sector to examine the principles of ownership. If you haven't already seen the previous video, this is going to not make much sense. There's a previous video about these 5 principles, but very briefly they are: first, the natural monopoly, which is that if a sector is a natural monopoly, this favors it being publicly owned, and the more competitive a sector, the more it should be privately owned. The second principle is physical survival, and this is very simple. If a sector produces a good or service that's necessary for physical survival, this favors it being publicly owned, whereas if it's more discretionary or luxury, then more favors private ownership. The third principle is percentage of population, and that's basically the higher the percentage of the population, the greater the argument in favor of the public owning that sector. The fourth principle is inequity risk, which is that if private ownership increases inequity from the goods or services out of that sector, then this favors public ownership. The fifth principle is non-economic benefits. This principle says that if a sector produces goods or services that are non-economic or very hard to measure in financial terms, that this sector should probably be publicly owned. With those principles explained briefly, let's look at how they might apply to the insurance sector. So insurance is not necessarily a natural monopoly, but there can be quite high barriers to entry for insuring very expensive items such as buildings or infrastructure. And people do not necessarily need insurance for their physical survival, but insurance is quite an important sector for protecting assets and livelihoods. For example, life insurance of parents will help to protect the livelihoods of children. House insurance enables people to rebuild their homes if they're destroyed in a natural disaster of some kind. Not everyone uses insurance, but most people will use some kind of insurance during their lifetimes. So a high percentage of the population uses insurance. Not 100% perhaps, but a high percentage during their lifetimes. There is a risk of inequity in this sector because poor people may not be able to take advantage of insurance if it gets too expensive. They might not be able to afford the cost, which puts them at a greater risk of being uninsured and, for example, losing their assets or livelihoods. This would then mean they fall further behind. While the insurance sector can sort of be said to have non-economic benefits, the essence of it is quite financial, and so this leans in favor of private ownership. But the other factors we've considered sometimes favor public ownership. So the insurance sector is probably ideal for having a mix of ownership types within the sector. This means a good model might be to have one publicly owned insurer to provide non-profit-based competition within the sector. The publicly owned insurer might only do basic things like vehicles and homes. This is where there's room in the insurance sector for private actors that might compete with the public sector or offer types of insurance that the public insurer doesn't want to, such as insuring artworks or other perhaps non-essential things. By having a mixed set of ownership structures within the sector, it ensures that prices don't get out of hand. If the sector is completely privately owned, then the incentive is for companies to buy each other out until we have just a very few number of large insurance agencies that can then increase prices because there's not much competition. By having at least one publicly owned insurance company that isn't motivated by profit seeking, it can of course break even or make a small profit, but it doesn't have shareholders that need to maximize their profits. And this changes the motivation for that publicly owned agency to simply provide the public with a good insurance product. This also acts as a check on the private insurance companies to make sure that they cannot charge too much, because if they do, then people will move over to the public insurance company. By having a mix of ownership structures within the insurance sector, this ensures prices are kept in check, but the choice and options that private companies bring into the market increase the options available to consumers. It is an important sector that's used by many people, is quite essential, and does provide some non-economic benefits.